Stated before, it's going to be about retail lending as a strategy to sell your homes directly to your residents. We'll let each one of the panel guests kind of give an explanation of what they do, what their company offers, and then we're going to open it up. By the way, this has been, over the years, up until a couple of years ago, one of the hardest sections to fill because the shadow lending, as we know, has just been dried up, non-existent, but it's starting to show back up again, which is a great benefit to some of you that don't want to carry paper or have big debt balances on some of these homes you're buying. So think about questions that you have for them and programs, and maybe even something around the SAFE Act, because these folks help you take care of all those issues and not worry about it. All right, you just introduce yourself and then we'll go along.
You would introduce your company and then we'll start asking some questions.
My name is Ryan Howerton. I'm with 21st Mortgage, and take that one.
Marie Layfield with Triad Financial Services.
I'm Al Randall with CSL Financial, based out of Birmingham.
Speak up for us in the back. Speak up for us, we'll hear you in the back.
I'm Al Randall with CSL Financial, and we're based out of Birmingham.
My name is Adam Peterson. I'm with AGS Capital. We're headquartered in Chicago.
Okay, I've got a couple questions for you to kind of get things going, but I really would appreciate some audience participation on this section. It's very, very important because, as I stated before, this area of our industry has been kind of dried up until recently, which is a good thing that's coming back. But the question to the panel is, do you have minimum credit score requirements and minimum income requirements, and what are they for prospective customers that we bring to you? So we can go down the line. If you have a minimum that's maybe a high interest rate, so you just kind of explain it.
Okay. We don't have a minimum. We have a couple programs. It's probably worth explaining. There's two levels of programs with us. There's regular retail financing, which is what you'd find at what a street retailer would have, and then there are communities that we work with that might want to implement something like that. Maybe you have a senior community or something like that. But for a family community, the typical credit score that we see is a 550 to 650 credit, and there's a lower down payment threshold that they have. And to match that financing up, we've structured some programs that we have where there is no minimum floor on the credit score. That underwriting, the community would have their own minimum thresholds that they would have on a particular customer. Down payments as low as 5%, and rates from 7.25% to 9.75% on new homes, and probably 7.75% to 10.75% on used homes, depending on the loan amount. We have a minimum loan amount of $10,000. So as far as those minimum thresholds, that's about it.
Our program, our lowest credit score is 600. We're mainly known for being a niche lender where most of our programs are the higher rated credit, which we have the best rates for those people. We just recently implemented a new program called the Silver Program, in which we're buying them 600 credit scores. We do have some fees that are charged directly to your customers, not to you. If that's the only way they qualify. We try to qualify them on the other program first, and if this is the only way we can get it done. Our minimum down payment is 5% down. On the Silver Program, it's 10% down required. We can go up to 300 months on certain programs, and 43% max DTI. We kind of stick to that program. We only do qualified mortgages. We do have a few situations where we've done something a little different. Those are individual cases.
We have programs starting with credit scores as low as 575, and down payments also as low as 5%. Of course, as the credit goes up, if the down payment goes up, your interest rate is going to come down. We have interest rates as low as 6.75, and they'll go up. Some of them may be 11.5, 11.75. However, we do not charge you or your customer any sort of points and fees. So when we're quoting you a rate and your customer, we're actually quoting you a true APR at the time from day one.
We don't necessarily have a minimum credit score. Once we get down below 575, we'll look to do a risk share with you to share in a small portion of that loan balance. Because you guys already wrote the credit on this resident to live in your park, so you should be able to help share that risk. Our rates will be as low as $599 for 740 plus FICOs and 20% down to 5% down payments and 600 or down to 575 at about 10 3/4. Terms will be normally between 240 and 300 months. So that's our basic overview.
Okay, second question. What's the typical time from application to approval or non-approval?
We do same-day approvals. When we get the application, as long as we get in before 3 o'clock, we can do a same-day approval on that customer.
Our case is a little bit different. We take your application in, your customer's application in, and we process it and we underwrite it. And if it fits, we have a lot of investors that we submit it to afterwards. So we have to look and see what the best investor is for your customer. So it's basically getting underwritten twice. We try to tell everybody, except on a Monday after a busy weekend of business, we try to tell them 24 hours. It's going to be at least 24 hours. Sometimes we get same day, but we're not the fastest on that end. But once it gets underwritten and approved, things go smoothly faster after that. But I always have to tell everybody to be patient. Give it 24, 36 hours for that good rate approval.
Well, we're sort of like Marie and Triad. We're definitely not the fastest. We can give you same-day approval. But for me to give you same-day approval, you need to give me a complete application at the time that it comes in. Back in the day, I think everybody basically provided a name, address, a social security number, and yeah, I think they got a job. With a lot of the regulations today, there's a lot more boxes on that application than those 4 questions. And the more information that our underwriters get at the time of application, the quicker we can get back to you. Typically, we can do same day, no later than next day, but I think the big key to that is getting the information in a timely fashion.
We use different originators who originate loans for us. And so if an application comes in and fits our buy box, down payment, FICO score, DTI, all of that type of stuff, if it fits our buy box, our originators have delegated authority to approve that loan. So again, if it's a complete file, that could be a 24-hour turnaround. It'll take another 24 hours if we're being asked to okay exceptions to an underwriting file. So, but in general, a final yes or no would be within 24 to 48 hours.
Okay, as a follow-up to that, from approval to closing timeframe.
Approval to closing can vary on a lot of things. There's some regulation that's out there that could, as far as the home, whenever you pull value on the home, or if it's a new home, there's an appraisal process that takes some time, like 7 days, before a customer can get contracts. There are some ways to speed that up through things like e-sign and stuff like that. It's going to vary a lot depending on what your customer is collecting for you, and with the, say the property manager is trying to help out and getting on those conditions. We have dedicated MLOs that call the customer and work with them. We have information that we try to provide that are very general things to say, hey, you're approved, please collect these things. But that time frame can really vary. It can go as quick as 3 or 4 days before you can close. It can go out a month, and there's a lot of variables in that, and a couple of things to look out for. But it traditionally goes pretty smooth and fast.
I agree with him. The main thing is getting your customers or with your assistants the conditions. I mean, as soon as the file is at a standstill until we get that information in. And I always say that it depends on the situation. Give it 24 hours for your conditions to be cleared. You'll get something back. The customer and you will get something back showing what is still missing. Or if you send a bank statement in, there's a question on it or whatever, you're going to get that back to give us an explanation of whatever the situation is. But really, that depends on you guys and your customers and how quickly you get us the information that we have asked for.
And I could not repeat what they said any better, so I'm not even going to bother to repeat that. The other thing that is a real obstacle right now, and it's none of our faults or anybody else that provides these services. How long is it going to take your factory to get you a house in stock? I mean, there are so many variables in that, and getting that house built is one, and getting the conditions met is the other. So, as far as producing contracts, it probably, once everything is met, it takes us about 15 minutes to produce them.
Yeah, again, I'm not going to repeat what everybody said because that's basically the way we approach it, but in general, that's a 7 to 10 day timeline.
Okay.
Last question I had was this whole safe act licensing issues. Can you tell me if your company alleviates that for the park operator, community owner, or do they need some sort of license training to be able to originate some of these loans?
When you're dealing with us, you do not need to have licensing for our company. We have, like I said earlier, we have dedicated MLOs that we put out there. We also have credit managers that are also MLOs. So we're not lacking anywhere on the ability to talk to your customer and work with your customer. I mean, there's different beliefs throughout the country about what a salesperson can actually do or a property manager can actually do. But it's generally understood that they can do clerical things and help out in that, and they're a good tool for that. They know the customer, they've got a person, they've seen and talked to the customer in person, so they're ideal for them to maybe and sometimes step in and talk to that customer about providing some of these conditions. But for the most part, we've got a dedicated MLO sitting right here that will call the customer, say, hey, how are you doing? Haven't seen any conditions in a while, and help move that deal along if it's going to become an actual deal.
I think you're going to hear the exact same thing from all four of us, because we don't require you to be an MLO. We have our own. We have people who call your customer. We also stay in touch with you, so you know what's going on with your customer. So, no, you do not have to be licensed.
Same.
Okay.
Is there any concern for community owners in being steering? Okay, so I have 21st mortgage. Do I have the pamphlets in my houses? If I have 3 or 4, do I have to provide 3 or 4 different choices? And how do I make sure I meet that requirement of the law?
Steering is probably one of the biggest things you have to look out for when in some of the relationships, especially when you're in a relationship with us. We're going to see traditionally when somebody is set up with us, we fit the profile of customer so well that's going into a family property that most of the deals will go through us based on what we can buy and what we can do that we see when we've got that relationship. But I think it's a risk to operators if you're only sending your application one place. And you kind of follow the model of what retailers have done. You look at Clayton Sales Centers, you look at just general retailers out there, they usually put up a lender panel lender board where we all market. I'm sure I don't want to speak for everybody up here, but we all have marketing materials that are put in there for the customer to see and to communicate to the customer as to why they would want to choose a particular lender. So I think that helps you if you establish that same kind of guideline in your community.
And I think something else that has really alleviated a lot of that is a lot of the communities that I've dealt with, as well as the retail dealers, when a customer fills out an application, they will provide them a list and say, we're approved with these lenders, here's the board, who would you like for me to submit it to? And I think that takes away a large portion of the steering. We'll all give you information to put in your models, to put in your sales center, in your community rooms, but make sure that you're offering that customer the right to choose whoever they want.
Question about the application. There is a cloud, a beige cloud out there that in some instances says the consumer must actually fill out the application, and in other situations, the dealer can assist or actually fill it out. Which is accurate?
I think they're both accurate, okay? Now, I do think that the consumer needs to fill out the application. However, if the salesperson that is working with them, if they are reading the application and they have some questions regarding their employment, regarding their income, things of this nature, I think it's perfectly fine for that salesperson to assist them in filling that out. I'm not saying that they can fill it out, but they can help them, guide them through the right information. One thing I tell customers all the time when they call me is, I understand how frustrating it is to them. God, I remember the first time I filled out a mortgage application, I thought I was going to pull my hair out, and back then I actually had some hair. So these people that do this once or twice in their life, they're not as comfortable with us as we are in this room because we deal with it every day. I hope that answers the question, or that's the best information I can give.
We're probably a little bit different on that as far as we want the customer to fill out the application. And if the customer's having a challenge with the application, they can call us. We've got our MLS ready to answer any questions and assist in that, and we'd be happy to.
For those of you whose companies buy portfolios of loans, this might be directed a little more towards you, Adam. Can you walk us through what the underwriting process is for the underlying loans in that portfolio? Like, for example, I've got a loan that was originated 5 years ago. Maybe it's missing some random disclosure. Equal Credit Opportunity Act is disclosed on one page. Is that going to disqualify that loan from you purchasing it as part of the portfolio?
No. At the end of the day, what I care about is, do I have an enforceable lien? And is that borrower paying? And then the third thing is I'm going to look at what's that loan balance in comparison to what the underlying value of the collateral is. So if if it's not brought date down to the most current regulations, it doesn't throw it out the window. What I'm going to do is I'm going to rely on the ability to enforce my position, and then I'm going to do a credit underwriting on it.
We also buy portfolios, and when we have situations like that, in some cases it might be curable when you have a situation like that, to not affect the price at which the portfolio will be bought, or it might change some of the guarantee or the repurchase on that for you as an operator. But it may change the deal just a little bit. And a lot of times those things are curable.
Right.
Could you address loan to value on used homes and relative value of used homes?
I'm gonna have to step away. Our company, we do not do used homes, so I'll have to step away from that one.
We require we do a data comp appraisal or an NAD appraisal, depending on the situation, and we use 90% of that for your value.
For us, on new originations, we'll follow that same approach for portfolio buys. As I said in the previous panel today, we're going to come out and we're going to look at the house and then have that inform our NADA evaluation, and then come in at about a 90%.
On consumer deals for us, we're going to look at NADA values to start with because it's quick, it's faster. We've got a long track record of it and using it. There's situations today with used home values may not align quite right with NADA. So in that case, we'll default to a data comp appraisal if it's necessary at that point.
100% or 90?
What's that?
90 or 100?
We do 120% of NADA.
No, the appraisal.
Oh, the appraisal?
The data comp.
100%.
With the consumer, what kind of FICO score are you looking for?
Everybody else is lower than us. We're 600 credit scores and above.
I'm 575 and up.
We'll buy a par at 575, and then we'll look for a risk share below 575.
We do all credit scores. All credit scores. We do 76 or newer on ours. There's situations where there's some areas like California where you can go older than 76 that we can do.
It would end up, again, on something like that, that's going to be somewhat of an exception for us. We will, have to get an appraisal on the house, and under the right circumstances, we would pursue that. If the house has been rehabbed, it's got a useful life, we may end up shortening the loan term down to maybe 180 months to compensate for that age of the collateral.
The same for us. It's on an exception basis after 20 years, but in certain places, like you said, in California, you can get an older home for a longer term. Sometimes we're short term, and in a lot of the cases, it is based on the customer also. You get an excellent customer, we might do a quicker exception than someone who's marginal.
Okay, any more questions? Or are we just tired?
Can I ask you a quick question? I know with both Triad and 21st Mortgage, I haven't really used more up until 2 years ago. I was using a broker.
His name was Chuck Barron's, and it made it really easy, and it also avoided the whole steering conflict, because I could say, go to this broker, and he's going to farm it out to whoever he has, whatever financial institutions he wants. And it helps on multiple fronts, because Chuck is pulling the credit score one time, and he's sending the information to the banks, versus them having to go to 4 different banks to fill it out and have their credit pulled 4 different times. So why don't the financial companies incorporate the use of brokers to help, one, alleviate the steering issue, and two, alleviate the affecting their credit score by pulling it multiple times?
We actually do have a broker program. We have brokers set up in not every state. Some states we have multiple. I have, my particular territory is Georgia and South Carolina and the Panhandle of Florida, and I have, I have at least one broker in each territory. In Georgia, a couple of them. If they're willing, and if I have a consumer call me, I will refer them to the broker to speak to them. So that is available for us. And if you have a broker out there in your territory, in any that you would like to refer to us, please have them give us a call and get them set up.
We do not have a broker program at this time, and I think a lot of it goes back to the additional fees and so forth that is being charged. So we're steering away from the brokers at this time.
We have broker relationships too, and you know they can be really good, and sometimes they can have some negatives about it as far as like you're saying the expense, or sometimes it's the time, it's the extra layer that kind of gets put in there as opposed to being able to work directly with it. So, but we use working bearings as well.
As we're an investor in the loans, we rely on our originators. If they want to develop broker relationships, we'll, as long as it fits within a total cost structure, we'll defer to them.
We have found that people that buy houses that we have set up in our community, ready to sell, like the idea of being able to close very quickly. We literally have people come in and in a matter of a couple of days, 2 or 3 days, we're doing the processing of the application and approving or disapproving them for a lease option and have them then move in literally within a week, sometimes 3 or 4 days by the time that they fill out the application. So frequently we're dealing with an impulse buyer. Same sort of people probably who buy cars off the lot instead of ordering a car from the manufacturer. How would you feel about us originating the contract, if you will, on lease option and then switching them over to a conventional loan a month or 2 down the road, where they would be less concerned about the time it would take you to process the application and close on it?
I think, based on your lease option program where you collect, a down payment, for us, it's seeing that actual down payment from the customer, that's important. I could see that could be a model that could work where you could originate and be able to do that in a timely manner. I think it is a challenge. The process today with regulation does create a challenge. We have the appraisal rules, the time that goes through there, and then the collection of things. One thing that can be difficult with us at times, they do qualified mortgages. That can streamline some of the things in particular. We venture outside, we do qualified mortgages, and we venture outside of qualified mortgages, which can require us to double check that customer's ability to repay in a way that maybe you don't have to originally on that, but you can get that customer closed and get them in and capture that, we know time kills deals. So I think that's probably an excellent idea, an excellent strategy on your part.
We have done a little bit of that, and it's something that I would like to explore more. The one thing that makes my underwriting team and probably my servicing team very nervous about that is making sure that we have the proper paperwork trail from the MSO to the title, to the lease option, to our purchase, okay? And I hate it when they call me and tell me I got to go stand at the damn DMV, so I ain't gonna argue with them all about that. But making sure that paper trail is there is one of the biggest problems that I've seen with that.
Okay, any more questions for the panel? Just another arsenal to put in your toolbox to help you fill your communities.
She's got a question.
Oh, I'm sorry.
Would there be any issue that you know of related to the transferring of the lease option down payment to a down payment on mortgage?
Any issue on relating, taking the lease option consideration into the down payment on the mortgage?
Or for us, no. I mean, we're going to look at the documentation on the down payment. What we're going to want to see for a customer down payment is, showing the documentation that you have and the source of it. And if we can get that, if you did a good job of tracking that in the beginning, just like what we would collect, we can work with that down payment as if it's the same on that. So what he's saying would work. I don't know how your titling process works, what you do with the title, just hold it, or the MSO as far as it goes. I assume that you go through and title it. So, I mean, it doesn't seem like that would be too much of an obstacle to overcome, since you have the power of attorneys to the customer review and whatnot.
So you basically just have to document or
write letters and all that stuff where your down payment came from, like any other traditional loan? Is that what you're saying?
Yeah, you certify funds going in, show them documenting that, and then proof that it's in the checking account or savings account or wherever the source it came from.
So you document the source of where the down payment is deposited and how it's going to be transferred over?
The documentation of receiving the funds and then the sourcing of the funds. So like bank statements and things like that. So he has that. I mean, you collect that when you do it. So he would be prepared for us to transfer that if possible.
Yeah, but like in the borrowers, you go to the borrower's bank statement, make sure you have the money to, where the source of the down payment was from.
Just showing where it came from. You know, that's the thing, that it wasn't provided to them. It's a real down payment.
Showing where it came from, but also showing that you deposited into your account. It came out of their account and it went into your account.
Yeah, so you're going back to transactions.
We're looking at his transaction because he had the documentation originally. I mean, I'll see situations where somebody they did a deal 3 years ago. And we can go back and look at it and know that they put we just want to make sure it's real down payment went in there. It's not an issue as much, I don't want to, for like retailers, on the deals that we see get done and the way we structured a lot of deals, there's not a lot of profit margin here. That's not the goal, is the profit on the sale. It's filling the site and getting the site running. So you don't see those kind of things happening as much as you would maybe in the retail world when sales get down and there's $15,000 profit in the deal. Well, you need $5,000. You want to know where the down payment came from.
Chris has a question, and I'll ask it for him. Will a down payment assistance program from a nonprofit or a for-profit, would you take a down payment assistance as part of that deposit documentation?
I would say in most cases, yes, but if we're doing that after the fact, after you buy it on a lease option, I'm not going to say carte blanche across the board that because there was a down payment assistance program that we're going to approve that.
Chris, would you be doing it on a lease?
You could happen a couple different ways. Lease to own, where a certain percent or a certain dollar amount per month is being applied towards the eventual purchase of the home that could be then used as a down payment. And then working in the nonprofit area, a lot of times there's grant monies associated with the home purchase that can be granted as down payment assistance that will allow that. I guess the question is, you already answered the question about the accumulation of down payment as long as it's been documented that it was collected and deposited into an account. The second part of that is down payment assistance. Do you recognize that as real down payment from that home buyer?
We would recognize that as real down payment. Anything from next step, we'll recognize as down payment. We do, it brings up the point of building up a credit. There's a lot of people that are out there doing that. I don't know what the panel does as far as a down payment credit program, but we will accept a down payment credit program as somebody building up, so they're paying a lease payment and they build it up over time, as long as it's agreed upon up front in their lease and it's documented and you've got a ledger that you can go back to. You have to kind of be careful with that. I've never had to establish a real policy on that because nobody gives away too much. Maybe $100 a month that they can earn, or maybe $150 a month. I've never seen anybody do anything crazy. But we just wanted to know that the customer realized it up front and they built it up over time, and those work. If you don't, you're just really doing zero down, and you're doing yourself a disservice because 5% is not a whole lot in these situations sometimes, but it's a real down payment. It matters.
What is the percentage that you expect the purchaser, the consumer, to come in with and put down? And also, if you made a loan today, what would the interest rate be on that loan? Does it vary with the consumer's credit?
Ours does vary with the consumer's credit as well as their down payment. The minimum down payment would be 5%. The lowest credit score would be, in our case, would be 6.49. But then there's a matrix, based on the credit score and down payment that changes both of those figures.
I have a question for, what do you guys do with zero credit scores?
We actually look at a zero credit score and price it as a 575, okay? If it is a true zero credit score.
Okay, that's about what we do.
We tell them to call 21st Mortgage.
Okay, I got time for one last question. No questions?
I got one.
Got one more, okay.
So if you do a lease option and take 20% down or something like that, essentially it's a lease option for it, and then you want to go refi essentially with you guys to turn it into a mortgage, how can is it possible for them to get cash out essentially if you could take down payment 5%, or would they be stuck with that full 20% going forward?
I'm not doing cash out.
Yeah, we'd say thank you for the 20% down.
Yeah.
That's why do we finance them in the first place? They got 20% down. That's what I think, I don't see too many of those like that, but we wouldn't do cash back on that either.
Okay, well, thanks, panel. Like I said, they had good information.